right, good afternoon. Welcome back from the break. I just heard from Jay. We have some wonderful news. Evidently, the live stream has reached 1,200 participants. So in addition to the packed room that we had here earlier, that's a pretty remarkable turnout and participation, so congratulations to the team organizing. I'm Heather Hogsett with the Bank Policy Institute, where I am deputy head of our technology division known as BITS. We work with the largest financial institutions and our regulators, some of which are coming up behind me. And we really focus on cybersecurity and operational resilience across the entire financial sector. So I'm pleased to introduce this next panel on cybersecurity regulatory harmonization in the financial sector, as this is pretty much a perennial topic of interest for our members and a critical challenge as we continue to move forward here. If you're not aware of the 16 critical infrastructure sectors, the financial sector has the distinction and honor of having, I think, the highest number of regulators and regulatory requirements for security, some of which are harmonized and aligned, many of which can be quite duplicative and create quite a compliance challenge for the cybersecurity professionals that we want to be able to remain focused on risk mitigation rather than compliance paperwork. So with that, I will turn things over to our moderator, Neal, and look forward to the panel.
Thank you, everyone. Thank you, everyone, for being here and for participating in this. We will have a robust Q&A session for the participants in the audience. And I'd especially like to recognize and thank Jay and his entire team for what has been an outstanding conference so far. And you got a tough act to follow tomorrow. So with that, I'd like to get into the topic of our panel, which is financial services focus on cyber regulation and harmonization. But I would like, even though we're going to focus on the industry of financial services, I do want us to consider a little bit broader aperture of not just the United States, but how regulatory convergence or harmonics or dissonance is evolving worldwide. And we are represented here by two of the American financial services regulators, but we also have two industry representatives, one which comes from a financial services institution which has worldwide scope, and the other one who has not only a mission, but products that are being used by financial institutions worldwide. My background, I was a former Chief Information Security Officer of UBS, which is a Swiss bank, and I was very much a consumer of some of the advice and camaraderie and help and tools that's really represented across this entire panel. So with that, I'd like to spend a little bit of time introducing our panelists because I think it's important to recognize just what kind of breadth and depth of expertise we have here to really go into what I'd like to focus on, which are historical opportunities looking as it evolves, but also historical successes and challenges in how regulatory regulations can harmonize. Especially on 3 or 4 specific topics, which we'll get into. But can't spell regulatory harmonization without regulators, so I'll begin with introducing our regulators. Rinku Sinha is a Cyber Risk and Policy Program Director at the Federal Reserve Bank of New York. She started her career many years ago, as an examiner at the Fed. We're also joined by Art Lindo, who is Deputy Director at the Federal Reserve Board. His responsibilities there include the development and assessment of the effectiveness of board policy matters affecting the U.S. financial services sector. We're also joined by Debbie Ng, who is Executive Director at JPMorgan Chase for the Technology, Cyber, and Policy and Partnerships Group. And she's responsible for identifying and shaping regulatory developments and engaging with FS authorities, presumably not just in the United States, but globally. And before that, she was the Chief Operating Officer at the Chertoff Group. And then finally, we're joined by Josh Magri, who's the CEO and founder of the Cyber Risk Institute, and we will certainly hear more about some of the products that are coming out of that organization that have directly facilitated the harmonization of regulatory reporting and expectations. Before he founded and took over and helmed the Cyber Risk Institute, he was the Senior Vice President and Counsel for Regulation and Developing Technologies at the Bank Policy Institute. So we are going to touch on a few topics that we thought were indicative of the challenges and opportunities and promise of regulatory harmonization, both retrospectively and going into the future. And there are 4 specific topics we're going to touch on. As we prepared, we decided, do we want to start with the depressing and sad, or do we want to start with the happy and joyful? And I think we're going to start with doom and mass hysteria, and then end with ponies and unicorns. So the first topic we want to talk about, doom and mass hysteria, is privacy. Some would argue that fundamental public policy goals on privacy have not evolved a whole lot, certainly in this country, since the Privacy Act of the mid-1970s. Whereas expectations of privacy, threats to privacy, technology, basically everything that touches privacy has probably changed a little bit since I was 5. So that is not just a US story, though. When you look at privacy regulations and how they've evolved, not just in the United States, not with the expectations for privacy, public expectations for privacy, but also in Asia, in Europe, with Asian governments coming out with very recent privacy expectations, with GDPR. There is a lot of movement in privacy regulations, but there's not clear harmonization and agreement on what should be protected, from whom, and for what purposes. And as we move forward with AI, which will consume massive amounts of data, which is personal data is the focus of much privacy regulation, what does that portend for the future of privacy regulation and any hope of actually harmonizing it so that when you're adhering to a data localization rule in, say, Switzerland or Monaco, you can also meet the expectations of privacy disclosure and privacy protection in, say, the United States or Asia or elsewhere in the EU. So that's the first topic I'd like to talk about. And as I think is compelling to hear from the regulators first, we'll go first with the regulators, then we'll go with the private sector panelists. And at Rinku's request, we'll start with Art.
Oh. Thanks, Neal. Good afternoon, everyone. I'll give the standard disclaimer. This is post-election, so everything I say is of my own thought. This is not a reflection on the Federal Reserve. So with that said, as my basic disclaimer, privacy. As far as we go at the Federal Reserve, that's not really our primary focus. We're not the regulator of most of those things. You'd see that more in the CFPB, for example, as opposed to us. So we're more of an observer, and then we're also a consumer of large amounts of data, so we have to protect it to industry standards and our own, which are fairly high. So with that, we're not the mover and shaker in this one. We're not creating more, we're not making more, but the idea is that we are participants in that. So there's possibly more of an SEC or CFPB concern, Neal, rather than us. I don't really have, that isn't a nexus of what the Federal Reserve is focused on. It's more of, we use data, we have to protect it, that sort of thing is what we normally get involved in when it comes to privacy. So I'm gonna summarize by saying it's something we're aware of. It's not something that, in terms of the harmonization focus that we have, that we are laser focused on solving that problem. That's not really within our remit.
Okay, Rinku, please.
So I'll start with a similar disclaimer. The views are mine and not those of the Federal Reserve Bank of New York or the Federal Reserve System. And I would say ditto to everything that Art just said. The only thing I'd probably add is a lens that we often think about when we think about data privacy is probably data management. And that's probably the focus for us, more importantly, as supervisors, how institutions are thinking about, not only developing their data, protecting their data, using their data, and that's really where our focus has been from that lens.
Thank you for those insights, because you do represent two of the primary regulators for the financial services industry. But of course, the financial services industry has a lot of personal data, personally identifiable data. Insurance companies probably have a lot of personal health information, which is governed by HIPAA, which actually has criminal sanctions involved for willful negligence and failure to protect the privacy of patient information. These are things that banks deal with. And with the topic of this is certainly regulatory harmonization, but I think it is worthwhile to discuss, especially our private sector panelists, the fact that there are a lot of regulators out there. And the regulators do have different understandable reasons and public policy goals. And I would like to ask first Debbie and then Josh, what has been successes, what have been useful approaches, but also where do you see as the challenge or even the future, if you want to prognosticate, on dealing not only with multiple, hopefully harmonizing expectations, regulatory expectations, but also different regulators. And when we talk about disclosure, we'll talk about disclosure a little bit. Now we're talking about not just federal regulators, not just international regulators, but the attorneys general of each one of the states setting their own expectations on disclosure and what constitutes PII. Debbie, please.
Yeah, Neal, thank you. As you say, data privacy regulation is some of the most fragmented in the regulatory landscape, and it's often held up as sort of the poster child of regulatory fragmentation. Thankfully, at JPMorgan, I leave this intractable problem mostly to our privacy lawyers, but I will make a couple of observations, which is if you look at the US privacy regulatory landscape, why are we so fragmented? And I think you can go back to our strong tradition of states' rights, right? Our 10th Amendment, et cetera. And also the different drivers and the reasons why these regulations exist. There are technology-driven reasons. There are reasons because you want regulations to protect vulnerable parties like minors, et cetera. There are sector-specific reasons, right? Like health. The health sector has their own privacy regulations, the financial sector, et cetera. And so there are many different drivers that create this fragmented landscape. And so you may be wondering, well, how is the EU able to pass GDPR, this sweeping privacy legislation that gives them a level playing field, and why can we not do it in the US? And I think you guys are all students. I'm sure you've studied this extensively, but obviously the reasons there is because they have different philosophy around privacy. It's driven by their fundamental belief that this is their a given right to have their privacy protected. Whereas in the US, you have this balance of individual rights versus business considerations. So we have that tension here in the US, which I will say it is what it is, right? And our regulatory landscape has allowed so much of our technology to flourish. So in a way, it's a double-edged sword. As a global institution, the one way I think that we look at this problem is, well, what are the core values to protect data privacy? We've got our customers and clients first. So what's the right thing to do? What should business be accountable? And you get to that and you look at, well, what are the regional drivers and the global drivers? And I think you can get to like a more manageable way to manage this fragmented environment.
So I would just add with respect to privacy is that's not an area where the Cyber Risk Institute, which is a not-for-profit organization that looks to enhance security through standardization, is looking to harmonize. And I kind of go back to one of my positions, and it was actually, I used to work across the river in the Bronx. I was a prosecutor there and handled appeals as well as organized crime cases. And on the appeals, most of the appeals were reasonable expectation of privacy appeals, search and seizure. So we still, as a country, haven't figured out what privacy means. That's not the sense or the case with respect to security or even artificial intelligence, which I know we'll talk on. There are certain precepts with security, confidentiality, integrity, availability. In artificial intelligence, you have really kind of 6 trustworthy principles that people have gathered around.
Thank you. Moving on to our next topic, and we will come back to revisit artificial intelligence later in the standards conversation. But moving on to the next topic, which is not a topic where we could really say that we've seen a lack of harmonization or convergence, because it's been an area of recent activity among regulators. And that is really putting regulatory focus on the adage, now possibly even a cliche, that cyber is a business risk. That's something we hear a lot. Cyber is a business risk. What does that mean? Well, the Securities and Exchange Commission and the New York Department of Financial Services have now imposed rules that are articulating what their expectations are when we say cyber is a business risk. They are, for the example, the SEC is requiring disclosures in the annual 10K forms of what the role is of the board in governing cyber risk, and the C-suite, the CEO, and the rest of senior executive management in managing cyber risk. So in a very tangible regulatory way, what that means is the CISO is not necessarily the most senior person involved in the organization on managing cyber risk. There is an emerging regulatory expectation that boards and senior executive managers have some view on what their job is on that. New York DFS has something similar and is actually opining on whether boards that are regulated by New York DFS should have cybersecurity expertise on the board of directors. And that was something, of course, that the draft rules of SEC toyed with. So my question for the panels, and we'll just really go from Art to Josh to Rinku to Debbie, is do you see this as a trend? Do you see as SEC, and I know that you can't forecast what other regulators will do, but given the history of people, many people banging on the table that cyber is not a technical risk, it is a business risk that merits attention by the senior-most parts of the organization. Where do you see the opportunities and the challenges, and really that sense evolving among regulatory expectations, not necessarily talking about specific regulators?
Right. So none of us in the room have any misgivings about the potential threats for cyber. We talked about this in the earlier panels, the multiple levels of losses that are likely to occur in the near term where they're being exploited. So nobody's opposed to that when we talk about it. The idea is who might be in the best way capable to either help an organization achieve a sufficient amount of defensive capability to mitigate or reduce those risks. And what tools should be used. For example, insurance wasn't mentioned too much today, but that's one of the means of mitigation here. So I think you're seeing a trend toward where do we lay responsibility where it can effectively change the direction of the organization. Now, does everything have to go to the C-suite? No, right? Our biggest fear tends to not be the C-suite individual making a failure. It's normally somebody on the line level who makes a failure, right? So it's the culture and everything else. So I would say that wouldn't be the only place to look. Governance and controls, we talk about it a lot, particularly in our regulatory function, but it is one point of emphasis. Again, I wouldn't put too much weight solely on the C-suite. I think it's more of a cultural issue. And each one of the regulatory agencies that operates in this space has a slightly different view. I'm not going to opine on the SEC's view being right or wrong as much as just one view. So I'd say that's a beginning, that wouldn't be an end.
Okay, and I think your comments actually would provide useful thought for people trying to figure out what any given regulator's expectations might be. It doesn't beginning and end at the C-suite, but there is shared responsibility, but it still also comes back to a cultural issue. Josh.
So one of the things that we have seen across the regulatory space, and Heather was up here earlier and talked about how we're the most regulated of sectors, financial services. I would encourage everyone to look at a Government Accountability Office report, and it came out right after Dodd-Frank and has a spaghetti diagram of the different agencies. There are 9 federal financial services regulatory agencies. There's 3 self-regulatory organizations. And then there's the 50 states, and each have usually an insurance, banking, and markets regulatory arm. What we've seen from the regulatory space is that, yes, there is this view that the C-suite and the board should be involved in cyber, right? But not in a management type of way, more in an oversight way. So when we were looking to create regulatory convergence, and I liked how Alexander put it about the East Wing, the OMB form, that's what we created for financial services. One of the questions that we have within our assessment is like, hey, how does cyber tie into your enterprise risk management program? Is it reviewed by your C-suite and board? And the expectation is you would provide some documentation to show that, because ultimately the board's role is to provide a bit of oversight and challenge to what's going on. And what we've seen in financial services is that a lot of the firms are really pretty good at weaving in cyber to their overall enterprise risk management program and bringing it up to the board level. Some are really good in that they've started to wrap that into risk appetite and risk tolerance statements and ranges as well. But this is definitely an area that's getting increasing focus, not only with the SEC, but globally.
Thank you. Rinku.
Yeah, I'd like to peel back the onion a little bit on the culture point, because I think it's a really important one. I think the board has an opportunity to set the tone for the organization, and then sort of thinking about it through the lens of, how they help the organization in that left of boom world of where you're helping them think through the risks that are, the businesses are being exposed to. The best way the board can do that is by understanding those risks. And that's where that responsibility, there's an opportunity there for the CISOs to be able to explain the risks to the board so they understand not just the technology risks, but the business risks associated with it. So they should be doing in partnership with the technology and business. That allows the board to challenge, because now that you know what the risk is, now you can actually challenge, well, does that make sense? Does that fit our appetite? And then on the other side of the spectrum, when something happens, we're starting to build that muscle memory for the board as well. So when an event happens, the board is not the last to sort of hear about it. They understand what's going on, who they need to call, so that they're better prepared from the response perspective as well. And all of that really comes from that foundational tone that they set with the expectation of their C-suite, help me understand so that I can provide you with effective oversight. I think that's one opportunity that the board has.
Thank you, Rinku. Debbie.
Yeah, I mean, first I'd like to commend NYDFS and the SEC for the leadership they've taken in terms of articulating the board's responsibility and really driving more of that accountability to customers from the top. And we're definitely seeing that trend, not just in the US, but in Asia-Pacific countries and also EMEA and Latin America. So we're definitely seeing that trend. I think my fellow panelists have already done a great job of articulating, what we think is the board's role, which is one of oversight. You ask people to be on your board for specific reasons, right? They have diverse experiences. They have specific, depth of knowledge, a certain maturity. They're able to challenge and ask the right questions. Their role really is of oversight. That's their role. And then you have senior management, and their role is to actually roll up their sleeves and be in the tactical day-to-day, identifying risk, setting risk appetite, mitigating those risks, and communicating that up to the board so that they can challenge what you're doing. That's really, what you want the board for. This reminds me of when I was at the Chertoff Group. It was probably around 2009, 2010. This was, cloud had just started making an appearance. People were trying to understand what the cloud is, so that just to put everything into context. And we were getting hired by CISO organizations to talk to the board, so that their board wasn't like, who are these cyber guys? Like, these are like the IT guys. You definitely don't want the board to be saying things like that. You want them to be well educated and informed. So what the SEC and NYDFS is trying to do is trying to make sure that the board is set up to ask the right questions, right? So how can you do that? You can set up a cyber education program. You can, we at JPMorgan, we have a monthly education program for the board. We make sure that they're apprised of any cyber news and evolution that is going on, lessons on emerging technology. And so they really have an opportunity to learn more about cyber and ask the right questions, and again, challenge. That's like the most important thing, right? You don't necessarily want them to have cyber expertise, but you want them to be able to take the whole of their experience and maturity to ask the right probing questions.
So I would like to follow up on this particular topic, especially given what all four of you have said. Does this, and I'll just ask an open-ended question, does this change the expectations or the priorities, expectations on the priorities of, or the core skill sets that would be needed in the senior cybersecurity executive, most commonly called a CISO, which may have evolved from a very senior engineering part? But when I hear the opportunity to educate the board, which means a skill that's shared among everyone else in the C-suite, which is the ability to explain to a board what it is that person does for a living. The role of culture, which is not necessarily something that is drilled in on 22 credit hours in a computer science degree. Where do you see the evolution, and answer it however you want to, whether it's the evolution of the priorities of a CISO, the evolution of the needed skill sets, or the evolution of regulatory expectations on the person in the hot seat, the senior cybersecurity executive for a regulated company? Let's just go the opposite way.
I think the CISO, for sure, the role has changed, right? You now have to be a little bit of everything. You have to have the technical expertise, but you also have to be able to communicate sometimes complex matters very clearly and articulate it to the board. I think the most important articulation that the CISO can bring to the board is risk. Like, what is the risk that we have? What's our risk appetite? How are we bringing down that risk? How do you know when what I tell you, like you're looking at this dashboard, how do you know what I'm telling you is actually bringing down the risk? So I think, yeah, from that perspective, you're starting to change the culture. Microsoft obviously is now post the Cyber Safety Review Board recommendations. They're really making a concerted effort to tie compensation to executives' ability to manage security. So you're definitely seeing that shift, I think, to be more than just like the tech guy.
Yeah, I think that's probably why we see so many business CISOs in a lot of these large organizations, because they serve that role of a translator for the business with technology. I think the one thing I would add about what might be different now than before for CISOs, they have to have the courage to say no to their board. And I think that's probably one of the hardest things to do when the bottom line is about P&L. And if you know as a technology person that you are really exposing your organization to risk, it is your obligation to be able to articulate that and why that's a risk to the board, so that they are making a wholesome decision, to your point, and thinking holistically, not just about the business and where they want to grow, but also where they want to protect and be sure that they're not jumping into something that the organization may not be prepared for.
I mean, I have really nothing more to add. I think, Debbie and Rinku said it quite appropriately. The CISO's role has got to evolve so that they're able to talk in a manner that is understood by the board, and the board understands risk. You have risk professionals on most boards, and going in and talking about this technical thing or that technical thing just doesn't resonate. So, the CISO is really going to have to start to up their game in terms of how they translate technical concepps.
Thank you. Art?
Up in the game is an interesting segue, because what I was going to do is contrast briefly what a board might hear on another risk topic that we're well familiar with, like credit risk, right? Mm-hmm. We would go in, we'd say, we're this type of lender in metropolitan New York. When it comes to CRE, we like these types of properties. This is our risk tolerance in some sense, how much we want to expose the bank to. You talk about concentration risk. You talk about a lot of things that would end up conveying how much risk the organization is willing to take and where they are along the risk spectrum, right? Mm-hmm. And then you correlate that with actual losses. In this space, we haven't quite matured the metric to that degree, but you have the same sort of considerations. We may talk about risk appetite, which is what types of technology you may want to use and what the downside would be for that. We may talk about concentrations, whether or not you're using certain types of providers and too many of them or not enough. And then lastly, we might say risk tolerance, which to me is one of those terms that when we talk about harmonization, obviously needs a little bit more work, right? What is the tolerance against? Okay, we talk about the tolerance for disruption when we talk about operational resilience, whereas in credit we may talk about loss tolerance in terms of bottom line loan loss reserve coverage or something like that. So in terms of the maturity spectrum, we're probably not quite there in cyber and operational resilience as we are in credit risk, but the same objectives exist in both, right? Communicate clearly what type of appetite does the organization have, what type of capabilities that they have, and what type of losses or resulting actions have we come from that approach. So you have a lot of the similarities, we just don't use the same terminology. So I think we're getting to a better place with that. And I think the CISOs are making a difference in that regard. That's where I think it's evolved over time, Neal.
I think that's a very important point too, because that's also a skill set to bring to it. The metrics aren't there, and whether a CISO would use key risk indicators, key performance indicators, articulations of due care, and whether they're meeting it, statements of risk tolerance, or this is what all of our peers are doing, and this is what we're doing, which is a frequent question from any board. The good news I see with that is the concept of risk management, as we know, is by and large a concept from the financial services community. And American financial services institutions have to have a risk committee on their board. Yeah. So institutionally and historically, they're well positioned to solve what you've identified as a very difficult problem that no one has quite cracked yet.
So if I may just kind of interject on this, I think this brings it back to actually the regulatory convergence piece, ironically enough. So for instance, credit risk, all these other risks, there's a standard way of talking about them. So then you're able to develop metrics around it. For cyber, where there has been kind of this disparate approach until just recently in the financial services, where people have kind of come back to much more of a NIST-based approach, you can't really create a metric that's consistent across multiple institutions because of the lack of standardization around even the terms and requirements. So I think we're going to get there, but when you think about credit risk and all these other risks, we have had 400 years of practice, on those. Not the case with cyber, and I would even argue that with credit risk, 2009 is probably a good example of we don't always get it right, so there are going to be some areas with respect to cyber when we start measuring things that probably aren't the right measurements. And that's why I think it's very important to kind of first come to a standard approach. I would put forth that it's our approach, the CRI approach, the NIST-based approach, in order to start to develop out some metrics and see which ones works and which ones don't.
Which is a great segue to our next topic, which is resilience, because as you pointed out, after 2008, 2009, when risk metrics weren't functioning quite the way they were expected and risk went south, there were new regulations, there were new laws passed to strengthen resilience against financial risks such as capital reserves for liquidity, so forth and so on, which is still a topic of conversation. Around 2019, there was a lot of regulatory activity, starting in the United States and then really following the opposite of the sun with other regulators worldwide on resilience, not whether a given bank can restart cold after a horrible cyber attack or ransomware, but the resilience of that financial institution's role in the system, which I don't want to mischaracterize what the Federal Reserve, but the Federal Reserve is focused systemically, and hence the concept of GSIBs. So 2019 is where we started to see a lot of regulatory movement, and that continues. And I would like to explore how the regulatory expectations among American but also global regulators have diverged or have converged on what it means to be resilient, on what it means to do a cold start from bare metal, if you will. And how do you know? How do you know you can restart from bare metal without shutting down the entire system and restarting it? But not just that, but also more recently, the other part of the new SEC regulations, which is reporting after a breach. So right now what we're talking about is sort of so-called right of boom, and it's not just the resilience that you can function at a minimum viable operational tempo while you're restoring things, but what do you report and when and to whom and why? And I think the why question is where we are seeing some divergence, not just in the United States, but globally. Attorneys general and privacy advocates and some of the other regulatory expectations, they want you to report within a certain amount of time so that consumers can protect their privacy from privacy theft, identity theft, whatever. The SEC wants disclosure, not necessarily knowing who shot Bob or what was ransomware or something else, but did it have a material impact on the viability of the corporation such that a reasonable investor would want that information before they purchased equities? and therefore put that in your 8K, please. Other regulators want the disclosure to know when there's been a crime committed and possibly eventually know whether you're going to pay ransomware, but also for the very, very valid reason of, are we under a systemic attack, or was this just one and done against a specific institution? What are they using? Give us that information, give us the indicators of compromise so we can protect the system. The common theme here is protecting the system as opposed to protecting any one institution. But I think there's convergence on why, from what, for what purposes, and when. And I'd like to start again with Art on where you see the challenges, or is this really a point of divergence, or is it convergence?
From the financial stability perspective, Neal, I think a couple of panelists have talked about the U.S. infrastructure. I'll just start with that as an example. I have no doubt that that should be what we protect first. Okay, so for me, personally, when I look at the 16 sectors, the 16 segments of our sector that we measure, those are the things that I consider would be systemic, and those are the things I think we protect first. The institutions that operate them are generally, private entities. They're not governmental entities. So then the idea is, how do each one of those functions actually operate? We go to individual firms, we assess that. I think that's the right way to go, but each one of those firms has a full business model of their own, which has to reflect the views of those stakeholders that we just talked about, whether or not they're shareholders, members of the board. So in that sort of environment, I think each one of us are relatively clear as to those who are, we call them part of the critical infrastructure. They know who they are. We don't make that public knowledge, but you can probably figure out over time who they are. And the idea is that a vulnerability in one of those that gets exploited could have disastrous effects on the full economy. So those are the sort of kind of trade-offs we talk about when you say disclosure, okay? So our first and most important task, though, is to continue to increase resiliency and make sure those systems can operate through a disruption. We talk about that. It almost sounds a little contradictory, operating through a disruption, but it really is how quickly can you recover and resume operations, because we know there are some things that are going to happen from time to time. So that, to me, was the focus that we should be pursuing, and for the most part, we are. The disclosure issue, as you kind of brought it up, that why are we disclosing, to whom, what time frame? I think that's replete with opportunities to streamline, opportunities to be very clear on why we're disclosing, and most important, opportunities to realize that if an event occurs, we're taking away valuable resources to provide that solution of resiliency when we have all these disparate requirements to report information. And how useful is that information? Most of the time when an incident occurs, as you all know, within the first 12 hours, we're still trying to analyze what it is, right? So writing or calling somebody, it's normally back and forth to the people who can help you. It isn't a report that's going to be issued to somebody for an enforcement action. That is not the priority. But for some, their edicts might be, we have to look at enforcement. So I would bring us back to why are we focusing on that disclosure, what purpose it has. Frequency, I agree with many of the comments earlier today. That's an opportunity where I think we could see more harmonization. It'd be nice if they all lined up, for example, right? 12, 36, 72, maybe we can get something that's, we split the difference. Maybe it's 42 or something like that. Not doing my math publicly, but you get the point, right? It's like 36 might be where it's a sweet spot or something like that. But, all joking aside, that is a clear opportunity where I think, think of the amount of time we waste because of that, the angst that goes around it. I'm a CISO. Do I really report this? Oh, it's going to be this. As opposed to, why don't you solve the problem? And then we can worry about fixing the blame later, but that's not the way a litigious society like ours thinks, right? It's, I didn't put my 8K in time, and there's a result. Anyway, I know we're short on time, so I want to make sure the other panelists get an opportunity to weigh in on that.
We have until 4, right? Okay, yeah. So please, Josh.
I didn't know if maybe questions from the audience, you wanted to do that? Or?
Yeah, we're going to do questions. Well, we have until 4, so should we go ahead? Well, I'd like the panelists to finish on the incident response, and then we can go to questions of the audience.
So with respect to the incident response, Art said it, there are opportunities for alignment there. And I know that the White House did not want to necessarily address the incident reporting piece, but that is like example A, right, of, well, what's the point there? The other piece is, to Alexander's point, you can do a lot of convergence or harmonization at the form level. So can we start to agree on what the data elements and the data fields are and the placement of it? Because when we were doing the profile, one of the things that we found out was much of the time is spent on trying to say, okay, it's almost like an LSAT exam question. Does it go to this question, this piece of evidence, or is this question the same as that question over there? So a lot of time is spent trying to figure out what the differences are, where if you just had it kind of categorized and more systematic, like a form, I think that would definitely reduce a lot of the angst and time spent.
Thank you. Rinku.
Maybe just kind of quickly, we're obviously very interconnected as a sector, and so that's the why, at least from a federal banking agency perspective, we want to know. And then because it helps us appreciate not just the firm risk, but the sector risk, and to be able to assess, the severity and the impact. But I think, when you talk about like what is resiliency or how we think about resiliency, there's the playbook piece that I think is really important, and maybe 30 seconds on that. Playbooks are super important, not just because it's a document that you've sort of laid out, the who, what, when, how you do stuff, but it's the muscle memory that you get to create within your organization. And then the more important piece is there's a lot of playbooks out there. I mean, FIBIC has one, SIPA has one. Every Tom, Dick, and Harry has a playbook. Do you understand the interoperability? And I think that transparency of knowing like where your playbook aligns with the playbook of others is where we can be the most effective and resilient in the sense that like we know where the handoffs need to happen. I know Art mentioned what we know in the first 24 hours is very different than what we know maybe 4 or 5 days into an event. So the first 24 hours, maybe the focus is really on the technology and the operation, like what happened, right? 3-4 days into it, if you have a disconnection, if you have a firm that doesn't have access or confidence in the integrity of their data, the conversation is going to be more about markets and liquidity and what does that mean for the financial impact. So now you've sort of gone from that non-financial event to a real financial event, which clearly is the conversation that should be happening at an organization, of making sure that people understand that the playbook is not just designed to just say, this is what your CISO is going to do, but this is what your CISO is going to do, and this is the handoff your CISO has to make to the business so that they understand what the next steps are going to be. Because it could be a very long tail event for an event.
Debbie.
Yeah, and I'll just quickly speak to just a private sector experience and try to end this on an optimistic high note, as you promised, because it sounded pretty gloomy, guys. So I think global institution, right, like JPMorgan, we operate in 100 countries worldwide. Every country doesn't have just one financial sector regulator. You can have multiples, right, as Josh had articulated earlier. So you do the math on how many different incident reporting requirements we may be subject to. And Art kind of went into details on what that kind of looked like, right? So for some countries, it's 4-hour reporting upon discovery. Some other countries, it's 72 hours upon discovery, upon determining that you have an incident that's reportable, and then the incident that is reportable could have different thresholds. Is it a material incident, a significant incident? And if you think about an institution, we just have one team that's responding to the incident. And this team is constantly being bombarded. Oh, and don't forget about the updates. Well, let's do the update in every 2 hours, every 4 hours, 24 hours, whenever you have something significant. So this team has to be constantly fielding questions. Well, we have to respond to the UK PRA and the Monetary Authority of Singapore at these different timelines. And these are the different data elements that they care about, because each regulator cares about something different, which goes back to the why. If you can articulate what the policy objective is that each regulator is going after and harmonize around that, then you can start to get to more harmonization in the area, right? So are the regulators asking because they want to be an early warning system to other institutions downstream or even our third parties? Or do they care because they want to be able to conduct thematic analysis for the sector so that the sector can identify thematic vulnerabilities and uplifts? So how do you get to understanding why regulators are asking for the information that they're asking for? So to end on the optimistic note, the incident reporting fragmentation has been worked on for a number of years. The Financial Stability Board, which I know Art is part of. Thank you, Art.
That is the happy note. I was going to say that. You cut me off. Here you go.
I beat you to it. So the FSB has been working for a number of years on convergence around incident reporting. And they've articulated what best practice looks like. And this is important. So for those who aren't familiar with the FSB is important because it's made up of the G20 central banks and regulators. So obviously a huge part of the global economy. And further, what they've just recently released is, to Josh's point, common data reporting elements for incidents. So it's 99 elements that they believe are reasonable for regulators to ask institutions. Now, if you think about a common, 99 might sound like a lot, but if you think about a common reporting template, you have this one team that can just fill out the details of the template and updates when they have it. And it can go to any number of regulators that have adopted this template. There you've provided an ability to automate and make efficient and harmonize on incident reporting. So not to make it so simple, but hopefully we're heading in the right direction.
Ponies and unicorns. So let's turn to the audience. I'll take 2 or 3 questions, jot them down, and we'll pass the questions to the panelists. Yes, sir.
So thank you so much. My name is Anthony. I'm at SIPA. This was such
Can you wait for the mic?
Oh.
The online folks.
Go easy on us.
So this was a very enlightening panel. Thank you. It focused so much on the relationship between financial institutions and regulators. If we could inject maybe a little bit about the consumer side. So to make it more concrete, the CFPB came out with the final rule on Section 1033 of the CFPA on reporting requirements for data to consumers. And it seems like a lot of the legal discussion has been about the liability if there's a breach. Now, how do you balance accessibility against, well, what's the word, security, data privacy? And then on the other hand, how do you move from a reactive posture on reporting and checking boxes to being more defensible? Thank you.
Let me take a couple more questions, and then I'll just turn it over to the panelists. Yes, sir.
Hello, my name is Kamal Thomas. I work in the financial services industry. So my question is regarding, as we think about harmonization across different financial regulators, how do we also think about moving from a more static framework to moving to something that's more sustainable given the evolving threat landscape, to make sure that the regulations and the guidance that are being disseminated are keeping up to the pace of the evolving threat landscape?
Thank you. One more? Yeah.
Hi, I'm Mike Paul. I'm CEO of a crisis PR and litigation communications firm called Reputation Doctor. I heard someone say earlier on the panel, and it's not an attack on you, it's just something I'm interested in, that the goal isn't to educate the board to the point where they themselves are seeking to be like a CISO or fully understand risk management from a cybersecurity perspective. But only a generation ago, attorneys weren't on boards, attorneys weren't CEOs, CFOs were not really on boards and were not becoming CEOs. So the question is, what is the 21st century best practices approach to board governance as you look at it from a cyber perspective? There are some firms like my own who are showing boards data that instead of becoming educated, they need a former CISO on the board, they need a former CHRO on the board, and they need more risk management experience, literally sitting in a peer seat versus being a consulting fee or a desktop that's once a month. Thank you.
Okay, so to summarize the questions, and I'll let the panelists tackle whichever one or all of them. The first one was relationship and how do you balance the security, privacy, and accessibility versus the compelling need to reporting. I think I characterized that one right. The second one was how do you make sure going forward that regulations, standards of reporting are adaptive to evolving threats, and that what institutions are required to do actually reflects the reality of the bad guys who might force them to do that. And then the third one was, I think to sum it up, should there be CISOs or cyber experts on boards, what is the 21st century best practice approach to cyber governance at the board level? So just start with Art and then make our way down.
I'm going to choose the static versus flexible for 100, Neal. And if in fact,
That was going to be mine.
that was yours.
Congratulations, you hit the daily double.
Let me
We'll
stop.
all do two.
No. Let's do. Tell you what, you do two,
Okay.
and then when you circle back, I'll go back to one. Why don't you go for two, since that's a popular one?
You want me to start?
You can start. I'll do the consumer one.
I'll just chime in.
I have to think about the consumer one. I don't want
So-
to give you an off-the-head answer.
So Cyber Risk Institute is a not-for-profit organization where we develop out standards for assessment. And the way that we did that was we utilized the National Institute of Standards and Technology's cybersecurity framework as essentially almost like an infrastructure or a platform, right? So the NIST cybersecurity framework really does a very good job of bucketing things. You have governance, you have identify, protect, detect, respond, recover. And what we did is looked at the regulatory provisions out there, and where you had essentially 10 different regulators say you should have a chief information security officer who reports regularly to the board. We said the one thing, but like high school math showed where it was, and that became an assessment question. And that allowed us to take down something like 2,700 regulatory provisions to 288 questions. So recently, the Federal Financial Institutions Examination Council put out a statement where they said that they were going to sunset their cybersecurity assessment tool because it wasn't being updated enough. And they pointed to a variety of things, including the CRI profile. CRI profile really is an organization that updates these things quite regularly. And we put out a new version usually annually, a major version every 3 to 4 years. And where we're going now with it is into the technology space. So you heard some people talk about OSCAL, I think, earlier, which is a machine-readable language that was created by NIST. And we're going to be developing our own profile standard around OSCAL, which will actually create a lot of benefits. One, you'll be able to query against the OSCAL standard, and it will be something that you can use with a variety of tools and vendors, Palo Alto networks, et cetera, and it will enable continuous control monitoring. And it's from that continuous control monitoring where Art and the examiners can look over the shoulder of the financial services and say, where are you getting attacked? That they can start to kind of dive a little bit deeper into those particular categories or subcategories of NIST and say, we might need a little bit more attention here as we start to set out regulatory policy going forward. So that's actually the positive news that we have to share is through vehicles such as CRI Profile or NIST, you will have something that's flexible and adaptive and can be built from and evolve with the threat environment.
Do you want to go first?
I'm ready to do the consumer protection, but if you want to finish out on static versus flexible,
Can I just add to his?
please go ahead.
I think there's a couple of other things I would add. FIBIC, which is the interagency group, and PHYSIC, which is the private sector, they work very closely together. And that's one way they ensure that they're staying on top of what are some of the emerging trends and risks that are happening. So those types of platforms, I think, are a great way to exchange ideas and to remain agile as necessary with the changing landscape. The other thing I'd mention is, CISA does a really good job of letting the sector know. multiple sectors know about ongoing vulnerabilities, and they also have additional resources and tools that various sectors can adopt to help further elevate their cyber preparedness. So I think, you're right. I think it's going to continue to change, which is, part of the challenge of regulatory harmonization is that we don't want to always play catch up, but at the same time, it's great to see that the sector and the public sector and the private sector are working together very closely to kind of stay on top of what's growing risks in this habit.
And I would just point out that physic-physic work resulted in a variety of deliverables related to cloud.
Yeah.
One being an extension of CRI profile for cloud services, but it's being the lessons learned from that are being utilized, and we're now going to be working on an artificial intelligence operationalization of the NIST cybersecurity framework, and this is all pre-regulatory. So this is allowing us now, rather than fighting, regulation that's duplicative, kind of saying, hey, here's some emerging areas. Can we kind of give you our views first off? And so that is something that really should be highlighted is the physic-physic work, as you mentioned.
Art.
Okay, so now I'm going to go back to consumer protection. Okay, so first, the same disclaimer. This isn't my area of expertise. So we have a whole division that works on this at the Fed, and they interact more directly with the CFPB than I do. But I wanted to talk about a couple things. One is, when we talk about consumer protection, the idea is, should the consumer own the data, and should the consumer have an ability to protect themselves no matter where that data goes, where it gets transferred? It's just been my observation that, in fact, part of the ownership rights, consumers have effectively signed away. When you click on certain things, you don't really think about it. So there's a little bit of an accountability problem that I see personally. I mean, I click on them too. I read them. When I read them, I'm figuring, there's a trade-off. How safe is my data and the like? So there's an ownership issue. I don't think we should indemnify consumers. This is my personal, indemnify consumers against everything. I think there has to be some accountability. Then the other side is, I do believe consumers should have a say in who gets access to their data. We don't have those structured laws in the US, much like you see in the EU, but I am an advocate for that as well. So for me, it's more of a balance now. And I'll probably stop there because my extent of involvement in that whole area is rather limited. So that would be my response. Happy to follow with you offline with the right people from the Federal Reserve System and the CFPB. That would be my initial response. So
Debbie.
Debbie?
Yeah, I'm not going to comment on the CFPB question, but before I get to the board question, I will say on the static frameworks, I think that's why Chevron is such an interesting development to follow, because what you could get is the inability perhaps for the independent agencies to act as quickly in terms of providing their own clarifications on ambiguous statutes, which would inhibit their ability to go from analog regulation to sort of the future of emerging technology, digital regulation. So definitely interesting space. On the board expertise, absolutely, I definitely think the board needs to be brought into the 21st century. Again, going back to my previous experience at the Chertoff Group, literally one of the things that the CISO organizations were constantly asking for is, how do I raise cybersecurity to be important and at the forefront of the board's thinking? So for sure, I think you've got it nailed, and that's why I think we're seeing that trend with NYDFS and the SEC really shining that spotlight and not letting the board get away with saying, hey, this is too technical for me. I don't know. Really, the CISO's responsibility, part of it is to educate the board and make sure, again, not to repeat myself, but have them bring up their education on cyber to such a level that they can ask good questions. And sometimes it's, because they're coming from diverse experience, it's an obvious question that maybe because you've been in your silo, you haven't thought about. So that's why the board's role should remain oversight. But certainly, I think education needs to happen at the board level.
Debbie, Rinku, Josh, Art, thank you so much. And please join me in thanking our panelists for a great discussion.